Welcome to World Energy. Today on Reality Check, we're looking at the perfect storm. I'm Richard Loomis, CEO of World Energy.
And I'm Jim Puplava, president of PFS Group and host of the Financial Sense News Hour.
Well, Jim, I think the consumer must be pretty happy right about now. The oil prices have gone under $60. I looked earlier today, it was at $57. Natural gas prices are low. The price at the pump couldn't be better. I think we've all forgotten that we were once upset at $2 gasoline.
Yeah, well, every single week I drive into work. This week, on the way into work today, the price dropped down to $2.71, which was amazing, Richard, because in July we were looking at close to $5. So on the surface, if you're a consumer, this is probably the best stimulus that you've seen come forth. This is better than those rebate checks that they sent out in April and May.
No kidding. If you look over here, when we're in Houston, our gasoline price is at $2.
Well, I need to move to Houston.
I think it's interesting what this actually does, is sending a price signal to the consumer. Last month and the month prior, the only bright spot in the automotive industry was that the SUV sales went from 3.4% of the total to 4.3%. And large trucks went from 13 to 14.4.
You know, it's amazing too, Richard, because there was a news special and they were talking to gas station owners. They were interviewing people that had motorhomes, and they're saying, you know, we're going back to normal again. So, you know, there's a false signal, I think, that when you look at these prices here, very similar to what we saw in 1998, when you hear almost ad nauseum demand destruction. And so there's this sense that this run-up in prices that we saw leading into July, where we saw oil prices go to, I think they topped out at 147, that this was an abnormality, and that really what we're seeing now with oil prices back below $60 a barrel are more normal. So from a consumer perspective, people are talking about we're back to normal times again.
Yeah, and the industry is reacting as well. If you look at what's happening with the E&P companies, several have announced cuts in their exploration budgets.
You know, this is something that I think maybe we ought to delve deeper into, because what do these lower prices mean? Because even though the price at the pump has fallen, the price of a barrel of oil have dropped to below $60 a barrel, the industry costs have not dropped below that, Richard. And as you've written about and others, we're taking a look at that. The marginal cost of oil is somewhere between $70, $75. If you're looking at the oil sands, you're looking at $85 to $100. And so a lot of these smaller companies that, number one, have marginal costs that are much higher than where the current price of oil is today, and number two, don't have the availability of credit which they need to expand their production.
Well, if you start looking at this, several companies already have said we're not going to go out and explore. But countries are in the same boat. I mean, if you look at the OPEC countries, Venezuela needs somewhere between $90 and $100 oil just to be solvent. And several countries need it at $85, like Nigeria. So a low price of oil, while on the surface may be helping the consumer, actually sends a shockwave through the industry.
What I found was almost astounding, which was several weeks ago on a Friday, the IEA released a preliminary press release for their study of oil fields, where the depletion rate is now 9.1%. At ASPO this year, they were assessing what the energy leaders thought was the correct depletion rate, and they said 8%. So we had the midterm outlook from the IEA that came out in August, and they moved it from 4% to 5%. 2 months later, they're saying after looking at these oil fields, the real number is 9.1%, which is actually worse. So we need to find between 5 and 6 million barrels a day of new oil just to keep running even. And from people in the industry, and you're closer to that than I am.
Well, and in today's environment, that needs to be very cheap oil, because expensive oil, you just can't do it. If the lifting cost is where it is today, and a $57 barrel, these opportunities are just not profitable.
What about the delays? Because industry cost, John S. Herald just released their outlook for 2008, where you had industry costs go up between 17 and 20%. So even though the price has come down, industry costs continue to go up, whether it's labor, whether it's raw materials. So what about the delays of new projects that were supposed to come on stream?
Well, I think what you actually see are no new projects. Several companies are just putting everything on hold. The smaller the company, the more they're not going to do. And it's actually worse when you look at how the credit crunch is affecting these companies, because they can't raise the capital to go out and drill. Their cash flow is down because the commodity prices are down. So they do what any good business person does. They put everything on hold. And of course, this takes into account that demand is going to fall off. But just from our conversation earlier, we know that there is a certain amount of demand in the United States that is inelastic. It can't change. If it could have changed, it would have at $4 gasoline.
Well, I want to move on to policy right now, because since Washington is in the bailout mode, for the energy industry, it's almost the opposite. They're talking about maybe reducing access to drilling, number one, and number two, some kind of additional profit or windfall profit tax. And of course, that creates a lot of uncertainty in the industry, because you don't know at what level will they set the windfall profits taxed.
Well, I think there's quite a bit of uncertainty. But when Obama was running for president, and now as president-elect, he put forward several policies that he wanted to enact as far as energy. One of them is the windfall profits that you're talking about. But lately, he's been talking about reversing executive orders that George Bush put out that could increase supply. Several of his policies seem to be actively reducing supplies of energy. And I haven't even gotten into the cap and trade yet and what that's going to do to us. Let's talk about stimulus for a minute, though, because in the last year, we've had 3 different proposals. Do you think what we're proposing on energy is a stimulus package?
Yeah, in reverse, because it's going to stimulate companies not to produce. And here's the amazing thing about this. You know, there's 2 sides of the equation. There's the supply side, and then there's the demand side. So you had 3 stimulus programs that the government talked about. They're already talking about another stimulus program that would come in 2 parts. One would come in a stimulus program, maybe half of it, between 150, 200 billion would be implemented before Congress recesses for the Christmas holidays. Then the second part would come in place when Obama was sworn in as president. So here's a stimulus program. Then we have other countries that are enacting the same thing. We saw this week where China is talking about a $600 billion stimulus program. So on the demand side, with the drop in energy, we're seeing an increase in SUV sales. We're seeing an increase in driving by Americans and also around the world. You've got governments that are enacting stimulus programs, so they're trying to increase demand.
That's correct.
On the other side of that equation is supply. And we know that the depletion rates are much higher than we originally thought, which means we need to have more energy just to stay even. And then we're talking about government policies here in the United States which would discourage new production, bringing new projects online. And then with the current price, you're talking about a limitation in terms of many of these projects, which are marginal to begin with, are no longer profitable. So why would a company invest the money and the resources to produce energy at a loss?
Well, now we're talking about the perfect storm. So we got all the governments trying to increase demand, and at the same time, economic factors and policy trying to limit supply. So what does that spell for us, Jim?
Well, I think you already said it, the perfect storm. And